Superannuation is one of your biggest assets, and along the journey of your working life and in retirement, it is treated as a pretty favourable tax concession that encourages Australians to save for their own retirement. Now, despite the generous tax concessions, you should be aware of the potential taxes that apply to certain beneficiaries upon your death. This tax can be in the form of tens of thousands of dollars for certain beneficiaries, such as adult children. In this presentation, I'll share some tips on who can be nominated to receive your superannuation death benefit and how to structure your superannuation to save on these taxes. My name is Sean Jones and I'm a financial planner at About Retirement, and you're watching About Retirement TV. If you're planning for retirement or already retired, you've come to the right place. On this channel, we present topics for those who are preparing financially for retirement or those who have already retired and looking for education on all matters retirement. Firstly, it's important to understand that your choices are limited on who can be nominated to receive your superannuation death benefit, unlike your personally held estate assets, which are governed by your will. Now, it's a common misconception that your will would control who receives your superannuation, but this is generally not the case, as superannuation is held in trust and essentially not a personally held asset. So, it's important you provide your instructions directly to your super fund. Now, whether your superannuation is held in the accumulation phase or the retirement income phase, your super fund will allow you to choose your beneficiary nominations. Firstly, the option for a non-binding nomination. Now, this is more or less your preference, with the fund trustee having the final discretion on who should receive your death benefit payment. Secondly, it's what's called a binding nomination. This provides more certainty, and the fund trustee is bound to making the death benefit payment to the beneficiaries nominated, as long as it's a valid nomination. And lastly, the option for reversionary nomination. Now, this option only applies for income stream accounts and allows for the account to remain active and for the ownership to be transferred to a spouse or child under 18. Now, if you were to pass away without a beneficiary nomination, the superannuation trustee will make the decision on your behalf based on who should receive the benefit and guided by superannuation law. Superannuation death benefits are paid as lump sums or as income stream payments. So I've focused most of this presentation on the basis of a lump sum payment. So let's quickly look at who can get your superannuation when you die. Well, firstly, your spouse or de facto partner being the obvious one. Secondly, your children of any age. Thirdly, financial dependent, someone who relies on you financially. Now, you also have the option of an interdependent relation. Now, this is someone who you have a close personal relationship where one or both provide financial, domestic support and personal care. And lastly, the option for a listed personal representative, which is essentially the executor for your estate. And this is where your death benefit can be paid to the estate and then distributed in accordance with your will. Beneficiary nominations can be made to more than one person, as long as they are all valid recipients and the total nominations equal 100%. Some people may want to nominate their brother, sister, best friend, niece, nephew, but it's important to understand that your choices are limited to the previously mentioned superannuation dependents, and any other nominations may be invalid. Now, another question I get asked quite often is, can I make a 100% nomination for my spouse, but also a secondary nomination for my kids in the event that my spouse dies before me? Well, the answer is you can only make one nomination at any one point in time, and there are no provisions for contingency nominations. So in most cases, it's a matter of updating your nomination if there are changes to your intended beneficiaries. So importantly, how will it all be taxed? The amount of tax withheld will be determined by firstly, who receives the benefit, and secondly, what are the tax components? Now, superannuation balances consist of three different tax components. Now, firstly, there's the taxable component. Now, this is made up of a rolling total of employer contributions, salary sacrifice contributions, and investment earnings. So in most cases, this will make up the bulk of your superannuation balance. Now, the next one is the tax-free component. Now, as the name suggests, the origins of this component would typically come from tax-free member contributions. Now, lastly, you've got the untaxed component, which is not very common, so I won't dive into it for the purposes of this presentation. but keep an eye out for it if you do have a government or public super fund. Now, these tax components are typically not shown in your end of year superannuation statement. A good tip is to go contact your superannuation fund and ask for the breakdown of your tax components. So earlier we described who can be nominated as a superannuation dependent to receive a death benefit payment under superannuation law. However, from a tax perspective, there are differences to who the ATO classifies as tax dependents and is shown in this table. You'll notice there are some similarities in tax dependent definition to superannuation dependent definitions. However, the main difference worth noting is that tax law doesn't capture a child aged 18 and over as a tax dependent. So this can have a bearing for nominating adult children and who also may not satisfy any other criteria such as a financial dependent. Now, as shown here, any tax-free component of your death benefit payment is paid with no tax withheld, regardless of the tax dependency status. However, for the taxable component, any amount paid to a non-tax dependent, remember, such as an adult child, would have 15% plus Medicare levy applied to the taxable component. Using this case study, we can see that Frank has passed away leaving $400,000 inside super, mostly made up of the taxable component being $350,000 and only $50,000 in the tax-free component. In the case that his widow Gwen receives a death benefit payment, the full amount is passed on and no tax withheld. However, if Gwen predeceased Frank and his nomination is changed to Lisa, his adult daughter, she is considered a valid beneficiary nomination, but not classed as a tax dependent. Therefore, 15% tax plus Medicare levy is applied to the taxable component, or in this case, approximately $59,500 in taxes withheld, leaving a lump sum of about $340,500. From an estate planning perspective, to preserve more of your savings for your beneficiaries, you should consider what super assets and what other estate assets should flow through to certain beneficiaries with different tax treatment. It's best to discuss this with your family solicitor or estate planning specialist for advice. As financial planners, we also consider superannuation recontribution strategies for clients to effectively reduce the taxable component and converting it to the tax-free component. This strategy involves careful planning, and the benefits for the estate can be significant. I would strongly recommend financial advice to consider the merits of any superannuation recontribution strategy, which is subject to many conditions. A comprehensive financial plan would factor in the value for your estate and leaving more for your loved ones. So I hope you found some value from this presentation, and please give this video a like and subscribe to our channel. If you would like to speak to a financial planner at About Retirement, hit the book a meeting button and then choose the day and the time of the meeting. And now please continue watching some of our other videos, with the first recommendation being Katherine's presentation about what you need to know about aged care advice. And the second recommendation is my video, Protecting Your Superannuation from Scammers. Now, if you have any questions or would like to dive deeper into any of the topics covered today, please feel free to reach out. And thanks for tuning in.